Types of general ledger accounts. The general ledger is a complete record of an organization's financial transactions over its life. The general ledger can be a set of physical books into which debits and credit entries are posted, or it can be in the form of a computer program. Information in the general ledger is used to produce the organization's financial statements. The general ledger classifies items as assets, liabilities, capital, income, and expenditure. What do these terms mean? An asset is a resource controlled by an entity as a result of past events, and from which future economic benefits are expected to flow to an entity. Non-current assets. These are assets kept long-term in a business. For example, equipment, premises, and motor vehicles. Current assets. These are cash items or items that will become cash within 12 months. For example, inventory, receivables, or cash. For example, the inventory held by an organization for trading purposes. This is a resource controlled by an organization, in that the organization has the power to restrict other people's use. As a result of past events, the inventory was purchased in the past. Economic benefit in the form of profits on sales of inventory are expected to flow into the company. A liability is a present obligation of the entity arising from past events, which when paid is likely to cause an outflow of resources from the entity. Current liabilities. These are liabilities that must be settled within 12 months, for example, trade payables. Long-term liabilities. These are liabilities that become due more than 1 year in the future. For example, bank loans. For example, a mortgage taken out by an organization. The organization has a present obligation to repay the mortgage lender as a result of the past event of taking out the mortgage. The outflow of resources from the entity are the mortgage repayments. The terms capital and equity are interchangeable. Capital is the residual interest in the assets of an organization after the deduction of all of its liabilities. Equity or capital represents the amount that is due to the owners of the business. Capital accounts show owners' investments in an organization. Capital investment is the money or asset value owners, or investors put into the business, for example, in order to start the business. And net income from the organization's operations. Net income is the income from operations less losses from operations, less any withdrawals made by the owner, owners, or investors for personal use. Capital accounts show the net change in the asset ownership of an organization. Basically, the capital account contains the value of how much the organization owes to its owners. Income is the increase in an organization's economic benefit during the accounting period that results in the increase in capital. This can be in the form of direct inflows of cash, enhancements of assets, or in the decrease of a liability. Revenue represents the earnings of an organization through its ordinary activities, and gains represents all other items of income. Some examples of income are turnover, which is another word for sales revenue, bank interest, and an increase in the value of an asset owned by the organization. Expenses are the decrease in an organization's economic benefit during the accounting period that results in the decrease in capital. This can be in the form of direct outflows of cash, depletion of an asset, or the increase of a liability. Some examples of expenses are cost of salaries and wages, cost of rent, loan interest payable, and inventory. For more theory videos, visit my website. If you found this video helpful, please let me know.